You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today, I've got my friend Ben Claremon, Principal and Portfolio Manager at Cove Street Capital, a value strategy focused investment firm based in California. Ben's here to present Lionsgate, LGF.A, that's the ticker, and the case for being long Lionsgate. So Ben, thank you so much for being on the podcast. The presentation that Ben's about to use, you can find that in the show notes or in the description if you're on YouTube. And let's get started with it. I'm really excited to jump in to this stock, and we're gonna have some Q&A at the end as well, and just talk a little bit about some of the other things that just dig a little bit deeper into this company. So with that, let's get started.
Well, Srivatsan, thanks again for having me on the show. I know it's not customary for your guests to put together a presentation, but personally, it helps me frame the discussion. I'm honored
that you put in the work to put together a presentation.
Yeah,
so I'm really happy.
Well, it's somewhat self-serving, but also if anybody's interested in this presentation, happy to share it, and hopefully we'll put it in the show notes as well. So the topic of the discussion today is Lionsgate, and the title of this presentation is "This Time is underlined different at Lionsgate." So always have to start with a safe harbor. Our disclosure, Cove Street does own Lionsgate shares. It is a recent addition to our portfolio. So in a lot of ways, I've followed this company and the media content industry for years, but I am by no means an expert on Lionsgate to the degree that maybe some of my colleagues are. Our founder has followed this company for 15 years. So, the deep nuances in the history, he'll be a little more well-versed in, but I think I can give a really good overview about why we own it. But as always, this is not advice, and it is not an offer to buy or sell a security. So do your own work and please read our safe harbor. So I always like to give people a sense of where we're going, and before we get in. So I'm just going to give a quick overview of a presentation before we get into Q&A, of course. So just a little bit about myself and about Cove Street. I'm going to talk a little bit about Lionsgate. If I call it LGF, it's just I get tired of saying Lionsgate. So if you hear me saying LGF, I'm talking about Lionsgate. I'm going to go over our contrarian investment premises, I guess, and what we're thinking that the market may not be thinking. What we think has changed over the last few years, because a lot of the people I talk to have this very backward-looking view of Lionsgate, and they're like, "Well, this happened in 2017," and I'm like, "Well, it's been 4 years, and we have a sense that a lot has changed internally at the company since then." And then we're going to get into the very messy, complicated subject of what is Lionsgate worth, and you'll see a number of slides on that, and it is a little bit of a painful endeavor because it is a complicated business or set of businesses. As always, I'm a value investor, so I do a good job of arguing against myself. So you'll see where we can be wrong and the risk factors associated with investing in this business. And then I'm going to share contact information, and we'll go into Q&A, and I may provide a shameless podcast plug for my own podcast, which is called Compounders. So just a little bit about myself. I've been on the show before, so you go back and listen to the original interview we did to learn a little more about my background. But I've been at Cove Street since 2011. We just celebrated our 10-year anniversary as a firm. I am a co-portfolio manager on our mid-cap strategy, and before Cove Street, I was at UCLA Anderson for business school, and before that, I worked on the buy side in New York at a couple of different hedge funds. Some people may remember the investment blog called The Inoculated Investor. That was kind of how I got my one of the things that kick-started my career in the investment industry. And I've moved from blogging to being a podcast host. So Cove Street, just very briefly about Cove Street. So we are located in sunny El Segundo, California. We're 100% employee owned. We have about $700 million done under management. We're a long only firm. We run concentrated portfolios, mostly think SMID, anywhere from SMID to micro. So basically 3 strategies: small, SMID, and micro. All value, different flavors of value, I would say. I mean, I lean very kind of like high quality, high return invested capital, what we call Buffett stocks. Our small cap strategy is kind of a mix of what we call Graham and Buffett stocks. So good businesses trading at reasonable prices, and then mediocre businesses trading at in really large discounts to intrinsic value. But whatever we do, we have 3 investment pillars: business, value, people. And you will see throughout this presentation that I highlight those, like those are the topics of the conversation. I produce a lot of content. Cove Street produces a lot of content. So if you want to go to CoveStreetCapital.com and go to our thoughts tab, you'll see a lot of different stuff from us. We're really transparent, and you can learn a lot about our philosophy and our firm, and hear from the different members of the team if you go to our website. So let's quickly go through Lionsgate, run through some numbers. The market cap's a shade under 3.1 billion. Well, this was as of a couple of days ago. Total debts around 2.5 billion. So net, and they have about 261 million in cash. So call it like just a little over $2 billion in net debt. Enterprise value is about 5.6 billion. TTM revenue is about 3.35 billion. Doesn't pay a dividend. And debt, which is something we'll talk about on a trailing basis, is about 4.7 times, which is a lot higher than things that I typically like to invest in. You'll see a little note here if you're watching the presentation that that number is actually 3.6 times if you exclude the investments in Stars International, which we'll also get into. I don't like to do that. That money's going out the door. I don't want to make an adjustment based on on management's thought of like, hey, we're losing money here, so you should not count it. But still, 4 to 5 times levered is kind of on the higher end of things that I would like to invest in. But I'll talk about why we don't think that's a really big issue. So 3 segments at Lionsgate, and so let me just go quickly through them. So the first segment is the motion picture segment. This is the movie studio that generates revenue through at the beginning of the pay windows, the theatrical releases. Then it goes to home entertainment, and then they also license the content to television and international content players. The film library, if you think about what Lionsgate is and the movies they have in their library, some of the newer ones: John Wick, Twilight, Hunger Games, Saw is one of their franchises, and Dirty Dancing as well. And they're also bringing back Dirty Dancing in I think the next year and a half. So that'll be interesting. But just they have a 17,000 title library when you include film and TV. And management gives you a sense of what that library generates in revenue. So on a trailing 12-month basis, just the library by itself has generated about $740 million in revenue. And management claims that the cash flow margins on that revenue are 50%. So a nice drop down to the bottom line. And so that's the first segment, motion picture. Second segment is television production. So this is the TV studio that creates content for Stars, which is one of their properties, but also licenses their content to linear TV players, AVOD and SVOD players. And if you want to know like what have they created, Weeds and Mad Men were both Lionsgate properties that have been licensed out to other players. They now deliver about 34 series to various partners. And they're actually seeing new demand for content from the AVOD players. But traditionally, whether it's Netflix or Apple, they're licensed. They create shows to license to those other content players. And this was a business that generated about $1.5 billion in revenue in fiscal year 2021. But just to make sure we're all talking the same numbers, that part of that revenue it overlaps with the library revenue. So when they give you a library revenue number, that's for film and TV. So it gets to like one of the most complicated parts about valuing this business is like what's the library content, but what versus like what's being produced right now. The last segment is media networks, and that's basically Starz and the Starz international business. You may recall that Starz was a publicly traded company. It was controlled by Liberty Media. Lionsgate bought Starz from Liberty in 2016 for about $4.4 billion. Keep that number in mind as you see our sense of what the business is worth today, because I think we're taking a much more conservative view than management took in 2016 about what Starz is worth. And so what is Starz? Starz is a premium, now it's kind of mixed between a premium linear TV subscription. So you can, if you subscribe to the cable bundle, you have a choice of premium channels. You can do HBO, you can do Showtime, but Starz is one of the options as well. So there's that, and they also have a D2C business, which has been growing pretty rapidly, and has recently flipped where they have more D2C customers than linear TV customers. And so in terms of total streaming customers, they have about 16.7 million globally, and total international is about 7 million subs. So out of the 29 million, of 7 million outside the US, they're hoping to get to 50 to 60 million over the next few years, which would be almost a doubling of what they have now. It is an ambitious goal. I think we have our own concerns about whether that will be achieved, but I think that's the management pitch, and we can assess whether that's likely or not, and value it appropriately. And one thing to note, as I did mention, the media network segment, which is mainly Starz, the profitability of that segment has been crushed by the fact that they're losing $140 million a year in international spending, which means that they're spending a lot more. That's just like that's the operating loss. So they're spending a lot to build international D2C. It's been growing fast, but of course, if you're losing money, you can grow subs. That's pretty intuitive. So the question is, can it ever become profitable? So let's move on to what we're thinking that we think the market may not be appreciating. So the first thing is the backward-looking comments that we have, that we hear from people when we discuss Lionsgate. One of them is, well, these are the guys that turned down a $40 bid from Hasbro in 2017. And, if they weren't going to sell then, why in the world would they sell when the stock is $13 or $14? And it's a fair point, but as I'll show, has underperformed to this degree over the last 5-year period. It is our sense that there are certain things on the table that may not have been maybe back in 2017. The other thing we hear is Mark Rachesky, who is basically the controlling shareholder. His firm is MHR Management, and there's this idea that he's this never sell bro, and he doesn't, he's never going to sell it, and he's going to hold it in his portfolio forever, and he controls the company. So even if someone wanted to buy it, they couldn't do it because they couldn't get through Rachesky. We think that is a misunderstanding and we're located in LA, and Lionsgate's in LA, so I think we have a little bit of an edge in terms of like industry contacts and people who know the company really well. And it's our sense that that is not the case, that he's like someone who would not sell the shares, and he's just like, this is his forever asset. The other thing to note is this is a Vancouver-based company. So while we'll get into this, but while Rachesky controls the voting shares, in the case that there was a takeover offer, the A and B shares both have one vote per share. So in that way, he doesn't control anywhere near as much of the vote as he would if it wasn't a takeover offer. So that's another thing that people say there's no way this company could be sold, but you have to remember that the rules in British Columbia and Canada are a little different. So the other thing is, I don't think there's no way to disagree with the concept that there is insatiable demand for content, right? Like, think of just the proliferation of services, AVOD, SVOD, so many services out there providing content. We think that the number of players out there who are selling content and need content makes the fact that Lionsgate can produce movie and TV shows more valuable, and as opposed to being less valuable. And the cool thing about Lionsgate is it's the last sizable independent studio, and that gives it a certain amount of scarcity value. in our mind. I mean, we'll talk about the MGM deal that Amazon's buying MGM, but we think that's kind of a proof point that there's a lot of demand for this content, and people are willing to pay very, very, very high prices because of the scarcity. When talking about the size of these libraries and the number of players left that are independent. We should also note that Blackstone paid a really nice multiple for Hello Sunshine, a business that basically doesn't have a library. So that was just like they spent $900 million buying an existing studio with a very limited library. So our sense is that there's a room for Lionsgate to be an arms dealer to other content players. And my guess is we'll get into this in the Q&A, but our sense is that every content producer, except maybe Disney, Netflix, and potentially Warner Discovery, if that deal, if that deal gets closed, everyone else in the world is going to need a licensed content from players like Lionsgate. And Lionsgate has a track record of coming up with great, very successful movies and very successful shows. And so unless you have just unbelievable scale and can just basically source your own content from your own studios, you're going to need a licensed content from other people. Stars, I think we've talked, I think if you listen to the way I've talked about Stars already, you can hear that we have some skepticism about like what's the true value there. Does it have staying power? Does it have differentiation? But the thing to know is that it throws off a lot of cash. EBITDA in the US is about $400 million. So, generates a fair amount of EBITDA. And our sense is that, what management has said is that they will not indefinitely continue to lose money in Stars International. If they don't think they're on a pathway to getting to 50 to 60 million subs, they're going to stop spending. And so it's really not fair to capitalize those losses in perpetuity by putting a multiple on the current numbers. That's their pitch. We'll see how that plays out over time. I think getting back to our three pillars: business, value, people. For me, the business and the people are really important, and I focus less and less on value because anything can be cheap, but you need a good business run by good people to make money. The value is what really stands out here. And we'll talk about the business and the people, but I think the sum of the parts value that we get for Lionsgate is so much higher than the current stock price that it makes you think deeply about who are your partners, what how good a business is this, because it's just so compelling that even if you have a little concerns about the people, you might be able to get over that given the margin of safety. So here's a slide on their stock price performance. So as of a few days ago, these are the B shares, are down almost 50% over the last since 2000, over the last 5 years. And if you just think about that, the degree of underperformance versus the market, it is very, very severe. And so my point there is that the stock has gone from the mid 30s to $13, $14 today. That is a big drawdown over a 3 to 4 year period. And the truth is, if the things that a company would consider after that level of underperformance over a 5 year period, I think are very different from if this company had been performing really well over the last 5 years. So it's important to understand the shareholder base because, as I said, people are a really important aspect of our investment process. And since you do have a base, kind of like a controlling shareholder here, it's really key to understand the structure and maybe MHR's motivations and intentions. So just as a general overview, there are two share classes. There are the A shares and the B shares. The B shares are the non-voting shares. And so MHR is the largest shareholder. I have some links here. It's an interesting saga if you go back and read. MHR actually bought the shares from Carl Icahn for about $7 back in 2011. And so I'll just point out that the stock, the shares are what, $13, $14 today. Up a fair amount from $7, but that's still not a home run at over a 10-year period. So it's been a double, but over a 10-year period, that's not particularly special, especially since, in 2015, MHR sold about 20% of the stake for around $33 a share. So we've seen a material diminution in the value of the shares that MHR owns since 2015. So MHR controls about 23.2% of the voting shares. These are the A shares. So it's not actual control. It's not 50.1%, but it is, they do have 2 board members, and Mark Krzyzewski is on the board. It does give them a fair amount of sway in the boardroom. Other key members of the shareholder base: Liberty Global, which is a public company, has a 2.9% stake. Liberty Global has a board member, which is CEO Mike Freeze. If you know anything about Liberty Global or Liberty Media in general, right? John Malone influenced companies. If there's any Liberty ethos, I've been investing in Liberty companies for basically since I got to Cove Street. If there's any Liberty ethos, it is find a way to monetize underappreciated assets, whether that's spins, asset sales, tracking stocks, divestitures. Liberty will do it. So, I feel confident that Mike Freeze, as a board member, understands how to create value for shareholders. And Discovery, which is merging with Warner, so it's hard to know what Discovery's role is here, but they have a 2.2% stake. So what's different now? So we've mentioned the stock price, and we've mentioned the pretty pathetic performance over the last 5 years. And that the current stock price, there's a huge gap between that price and what Hasbro allegedly offered, which was $40, and where MHR sold stock in 2015, which was around $33. So, we're talking about a big discount to that. I'm not anchoring to those numbers, but I'm just making a point that, we're not talking about a stock that's $30 anymore. We're talking about a stock that's in the teens. One thing that's happened positively at Stars is that the Stars used to be kind of just a throw-in. So if you got the cable bundle and subscribed, whatever you subscribed to, or you just bought the cable bundle, they may give you Stars for a year for free, right? And so were you really a Stars subscriber, or were you just there because you got it for free? That used to be a bigger percentage of their customer base. Now I think it's down to about 20% that are kind of on promotions. And then, as I mentioned, now they now have more OTT subs than linear subs. So my sense is that to some degree, Stars is like something that people are actively choosing to subscribe to, as opposed to just getting it free with a cable bundle. Another thing that we talked about a little bit, but I think library content and then the ability to produce content for others has actually become more valuable. Given the proliferation of content and the number of players out there who are desperate for content. It's also worth noting that the CEO and vice chairman are both 4 years older. These guys are not spring chickens anymore, and so there's always a question about what is their intention. Are they gonna be like Buffett and be in the seat until they're in their 80s? My guess is probably not. And so as it's been a difficult number of years, and I just think as people get to the late 60s. They start to think maybe a little bit about what the future of this company is. And so we're not saying that's necessarily a catalyst for a sale or a divestiture or a merger or of any kind, but it is possible that these guys are thinking about what the next step is. Another thing to note is MHR, which still owns a huge chunk of this stock and who's seen it go from 33 to 13 or 14. Their performance probably isn't great as a result of that. And so the question is, they still have outside investors. Is there any pressure whatsoever to monetize this asset? And we think that for the right price, MHR is a rational actor who will consider very reasonable, a reasonable price of some kind. And then getting to the consolidation point, how much consolidation have we seen in the industry over the last number of years? We've seen CBS and Viacom merge. We've seen Warner and Discovery about to merge. Amazon's buying MGM at a very healthy multiple. But I think as the number of content players dwindles And the players that don't have a lot of scale in terms of the amount of, the library and the content that they can put on either their D2C or linear platforms, like there's just going to be a rush for scale. And being the last independent studio of size, I think it positions Lionsgate really well. And if you look at the multiples that D2C streaming companies have been receiving, and especially like on a pure play basis, I mean, they're pretty attractive. And everyone wants to be part of a subscription business, and of course you can't separate D2C from the linear TV side of Starz. But our sense is that if Starz can have 50 to 60 million subscribers over the next few years, that's a very valuable D2C platform. So now getting to the trickiest part here, which is valuation. So stock doesn't screen particularly well. If you look at the stock based on consensus 2022 EBITDA numbers, it trades at about 12 times, which is not insanely expensive, but this is a business that doesn't traditionally, because of the weird cash flow dynamics of the movie studio, doesn't generate a lot of cash, and the cash flows are hard to predict. The other thing that makes it complicated is that there's not really a lot of pure play public comps left for the movie studio. So we own DreamWorks when it was bought by Comcast. That deal went out at about 4.1 times sales. Very similar situation where we thought DreamWorks was a really good asset, great library, great ability to make new movies, and I would put DreamWorks up there with Pixar as some of the best animated movies. We saw an undervalued, undermonetized asset, and Comcast really validated that. I think we see a very similar thing here with Lionsgate. So that business went out at 4.1 times sales. I'm not saying that Lionsgate could get that, but that would be a $15 billion enterprise value for Lionsgate. That is a big equity per share. Let's not anchor to that. I'm just pointing out that this is a precedent transaction of maybe a superior asset in some ways, but also an inferior asset in other ways, because DreamWorks library is nowhere near as large. So Starz, so remember, it was bought for $4.4 billion, but EBITDA is down since then. Not the kind of performance you want after a company, you buy a company. Part of that is the international rollout of Starz Play, and that's been very costly, and it drags down the profitability of the segment. And so what do you comp that with? There aren't a lot of pure play comps for Starz either. And so AMCX is kind of maybe the best decent comp. And if that's your comp, it's not very particularly attractive, because AMC trades at less than 7 times EBITDA. So if that's what your benchmark is, you're certainly not getting excited about what Starz is worth. The other thing you see is that sell side analysts are valuing these companies on they'll value the linear side or the non D2C side in one way, like at whatever 4 or 5 times EBITDA, and then they'll put an EV per sub multiple on the D2C business. And we have a chart here that shows that somebody doing that for AMC's D2C business. And yes, AMC is worth a lot more if you value it on a per sub basis as opposed to on a cash flow basis. This reminds me of the tech bubble when people were pricing things based on eyeballs, because they didn't, because they weren't profitable, or you couldn't see the profitability. So you're valuing it based on some kind of well, Netflix trades at this on an EV to sub basis. Well, we'll discount that by 50% and put that on AMC or Starz's D2C business. Not something that I'm interested in. I mean, we really want to focus on cash flows and EBITDA and other things that there's a tangible cash flow or EBITDA that you could value, as opposed to just some kind of subscription or eyeball number. One of the complicating factor here, as I mentioned, this company has a fair amount of debt, and there's almost $180 million of interest expense. And so if you look at their income statement, getting to the point of why this doesn't screen particularly well is you'll see net income losses because of that. And I certainly don't love as much debt as is on this business. I think it's a manageable amount, but for sure, free cash flow is being reduced by the interest expense, and it makes the income statement very hard to get excited about. And then lastly, accounting for films and TV programs is complicated. It's very hard to predict cash flows. You have big amortization charges, as well as, you know, distribution and marketing costs through the theatrical side. It's also a hit-driven business, so you can have a really big movie one year or a very big licensing of a movie one year, and then that rolls off. And so it's really hard to know what kind of run rate cash flows are going to look like. And so what that means is that this is not a business you can do a DCF on. It doesn't make any sense on the DCF, and neither did DreamWorks, by the way. I'm not you know, benchmarking or anchoring to that, but for sure neither did DreamWorks. So one interesting tidbit before we move on into like the nuts and bolts of our valuation is something I'd never actually seen before, which was that a board member by the name of Garry Crawford, who was a former PM at Capital Group, which is a very large investment manager here in Los Angeles. He did a call with the JP Morgan sell-side analyst. So I'd never seen a board member get on a call and basically do what he did, which was walk the audience through how he would value Lionsgate. And so recall, this is a mid-teen stock, and he publicly put a $33 per share sum of the parts value out there. And so, you know, obviously he's biased to some degree because he's on the board, and he's been aggressively buying shares. I mean, he's bought shares aggressively since August of 2020. You can see the number of shares here on the chart I have on the slide, but he's bought the B shares as high as 1570, which is higher than the current price. But this is a guy who goes on a call with a sell-side analyst saying the stock's worth $33. That's a big difference between between the current stock price and what he thinks it's worth. But I think more indicative or more interesting than the numbers he put out there or the analysis he gave us is more like the fact that management would allow a board member to come on and talk about how unbelievably undervalued they think the stock is suggestive to me that the management team is thinking about the stock price and is thinking about potentially monetizing assets. Another thing that we need to talk about is MGM, because it's everyone, I think, it's really easy to rush to the MGM valuation and be like, oh my God, put this on Lionsgate. Look how much Lionsgate's worth. But I think it's worth looking at these two businesses and saying like, okay, how similar are they? So no content company is the same, but it's worth comparing the $8.45 billion that Amazon's paying for MGM versus what you would get at Lionsgate. So both libraries, and this is like a total coincidence, but both libraries have about 17,000 titles. I think Lionsgate would argue that they have a larger library of newer films. Like MGM has a lot of older titles from like the 50s and 60s that are black and white. And, how do you monetize that today is a good question. So Lionsgate's given us some stats. Like if you look at wider release movies, which I think means like theatrical, over the last decade, Lionsgate's put out 121 versus 44 for MGM. The box office for those is like $6.5 billion over a decade versus 3.1 billion for MGM, and total movies over the last decade, 704 for Lionsgate and 159 for MGM. So, no library is the same, but I would argue that a newer library has more monetizable content than something that's like, for sure the Bond franchise is really valuable. But let's remember that MGM doesn't even control the Bond franchise. Like there's like an outside not controlling, but an outside influence there that has some control over the Bond franchise. And so you don't have those problems at Lionsgate. And then also MGM on Epix. I would argue that Starz is a better platform than Epix just because Starz is a premium subscription product. I would also say that Lionsgate's TV business is better than MGM's. So the ability to continue to produce hit content for other TV players, I think, is probably better at Lionsgate. But there was also some talk that MGM's library has been under monetized, and that Amazon may be able to find ways to unlock ways to monetize that, and that's why the valuation looks so high. Because Amazon's baking in a way to monetize certain assets. So Garry Crawford, when he did the presentation with JP Morgan, he said basically if MGM is worth 8.45 billion, then there's no way Lionsgate is not worth that much. on an EV basis. And if you just put that number on, and again, I'm not going to anchor to it because it's not a perfect comp, but if you put that number on Lionsgate, it's $26 a share. So we're about to get into the valuation. I promised you this would be fun. So some caveats before that. It's a pretty difficult company to value. As I said, the MGM multiple may not be applicable. If you're willing to adjust Star's international losses, you are, at least in the short run, overvaluing that business if you're ignoring the losses they're generating. The other thing to note is that Stars and Legacy Lionsgate, which were merged together in 2017, maybe it's going to be, maybe you can't split them up so nicely. One of the reasons why for that is that the Lionsgate content is continuing to migrate onto the Stars platform. So if I'm subscribing to Stars, as Lionsgate's licenses are rolling off other places, Stars is picking up that content. And so they become even more intertwined over time. And the other thing I mentioned is you have to be careful about double counting the library revenue, because that library revenue includes TV and motion picture. And so you don't know at what proportion. So it makes the whole valuation a little more squirrely. Our research suggests and our nose for value suggests that this is a special situation, that this time is different, and that there's a clear desire at Lionsgate to close the gap between the share price and the company's estimate of intrinsic value. But we don't like to invest solely based on a sale. I think that's a fool's errand. Like, you name me any company and I can come up with some reason why it should be sold. But the base rate, just think about if you own a 30 stock portfolio, how many of your stocks are going to get bought over a year, right? It's not 100%, and it's probably one or two stocks, if that, in a small cap portfolio. So the base case is that most of your portfolio is not going to get bought. So I think you should start with the idea that there are multiple ways to make money. The sum of the parts value is really high, so if there was a buyer, we'll make money. But also there's internal momentum that can improve cash flows and margins and returns in a way that gets you a higher stock price. And so in this case, Stars and Lionsgate have a number of things going for them. One is the continued growth of the TV production segment. They just continue to pump out new content that they license to other TV players. What happens with Stars? Like, if Stars does become profitable and they can get to 50 to 60 million subs, that's a totally different story. And all of a sudden, people have a very different perception about what Stars is worth. Or the losses continue for a certain period of time. They're not getting the traction they see. And then all of a sudden they turn off the spigot. And all of a sudden, when that happens, you see Stars being a much more profitable business again, and then hence potentially a higher valuation. Also, clearly, both theatrical production of new films and the theatrical presentation of films has been disrupted by COVID. And so the question is, what does revenue and cash flow look like in the theatrical segment, the motion picture segment, if and when COVID is not as much of a part of our daily lives. I think the important thing to remember, though, is that if the stock were $20, $25, all of these things would be really concerning, and they are concerning. But I just think the margin of safety you get, given the sum of the parts value, protects you a fair amount from further downside. So here's our valuation. As I said, 3 pillars: business, value, people. We've talked about the business, we've talked about the people. The value here, and I say this with a fair amount of trepidation, is the value here is what got me excited. I'm still I'm still the guy who started my career reading Ben Graham's book. So I am attracted to undervalued, underappreciated securities. But I do like to invest in businesses that are getting more valuable every day. And I have a fair amount of conviction. We have a fair amount of conviction at Cove Street that the motion picture and TV production business is getting more valuable over time. Stars, maybe a little bit of a question mark. So if you look at our valuation methodology, it assumes the A shares and B shares are treated the same in a deal. That may not be the case. We have seen situations before where the B shares are sold, like control is sold to another party at a premium, to where at a huge premium, and the A shares wouldn't get that premium. So that's a caveat you need to be careful of. about like who the buyer is and how this gets transacted. But we're assuming, just for simplicity, that the A shares and the B shares get treated the same on a per share basis. So the methodology is, first you value the library, which, as I mentioned, includes TV and motion picture content. And when you just value the library, it basically assumes that the existing studios are worth nothing more than the past content. So it's basically zero value for any future growth in cash flows from the library. So just you take a print of $740 million today. That's what the library generates, and that excludes a lot of other revenue. But just to be conservative, let's just value the library. And to my point, Garry Crawford, when he did his presentation, put a $1.5 billion value on the TV business outside of the library. So, that's another $6 or $7 a share, if that's the case. So, but we're not going to do that. We're trying to be really conservative here because this is complicated. And so, as we're valuing the library, the press reported number for the library on the MGM Amazon deal was 20 times. We think that's a pretty aggressive multiple, and that may not be replicated. So we're going to use 12 times, which is 12 times a cash flow number, which is, I think, probably pretty conservative. But given that most of this is free cash flow, it's all basically all free cash flow. Are the numbers we're using, and there's no capex associated with it, and this is just like licensing revenue. So in our base case, we're using 12 times, and our upside case, we're using 15 times. So that's for the library. The second step is to value stars. In our base case, we add back half the losses because we don't think it's fair to capitalize those losses in perpetuity for stars. So we add back half the international losses, and we apply an 8 multiple. And then our upside case, we exclude all of the losses, and we put an 8.5 multiple on it. That's a slight premium to AMCX, which we think stars is a better business. And then it's always so hard to figure out what to do with corporate G&A. We put, in our base case, we put a 7x on it, assuming that there would be some synergies with a buyer, right? Someone would be able to cut costs or be duplicative, arrangements of some kind. And in our upside case, we value the corporate segment, which is a negative value, at 5 times. So that gets down to the maybe the most important thing for what people are interested in, and that's our SOTP value. So given all those caveats I just gave, and all the methodology that I just laid out, our base case is $18. But remember that values the future revenue from the studios basically at 0. And it capitalizes $70 million in stars losses into it. And then it also uses a multiple that's what 60% of what Amazon paid for MGM's library. If you're just a little more aggressive and put a 15 multiple on the library as opposed to the 20, you get 2750. But still, like, we're just valuing the library, and it values the future revenue from the studios at 0. So both of these are lower than what Garry Crawford put out there. I think what you're seeing is, even in our base case scenario, there's decent upside, being pretty conservative about valuations, and then you've got a multi-bagger opportunity if our upside case comes to fruition. So where can we be wrong? I mean, if I haven't already, argued against myself enough, I'm going to do it more. I think the short points here are the leverage is too high, and it'll eventually be a problem. The second one is, what Amazon is paying for MGM is not a relevant benchmark whatsoever. It's just the libraries are not comparable. And, I think there's some risk that this deal doesn't even get done, because it has to get through an FTC review. So we'll see if this Amazon MGM deal even gets done. And if it doesn't get done, then who cares what Amazon was willing to pay, because it was never going to deal, and didn't even get through the regulators. The other short point, and I've talked about this, is stars is a subscale business that gets less valuable every day, and management will continue to throw money at it regardless. Like, management has a higher view of stars than I think we do. They have a lot more data on it, and they can see the numbers. But I think, to be conservative, we are assuming that stars is not a melting ice cube, but not something that is not a quickly melting ice cube, but not something that's getting more valuable. Another good point, which is brought up over and over again, is that no single buyer wants stars and legacy Lionsgate. I think that's a fair criticism. that, that you could see people who want stars or want the studio, but who wants both together. Obviously, MHR is a huge wild card here. What is Rachesky's desire to monetize assets? Is he a never sell bro, and he'll hold this till it's $1 and in 2028? We don't think so, but he holds a lot of sway in the boardroom. And so even if someone offered $22, which if you bought it today, you'd probably be pretty happy with, Rachesky might turn that down because he thinks it's worth 40. Another thing that to think about is that Lionsgate is running out of potential partners. I don't know how many, there's been so much consolidation already. What else could get through regulatory is a good question. Who still wants more scale and to buy, who would be interested in this library? And especially if you listen to the Biden administration and how they want to crack down on consolidation, it's a good question about, who the buyer is and whether they could even get approved by the regulators. The other thing we hear a lot of is that Feldheimer, who's the CEO, and Vice Chairman Burns, this is their baby, and they really have built it into what it is today, and they're never going to let anyone control it. And they can basically help. Rachesky can help them block any suitors, and so that's why having two share classes is often, and in this case, I think, problematic. And then the last thing we hear, and this is a very backward-looking thing, and I think it's why we want people to start thinking about it and taking a look at it and maybe rethinking what they thought about this company, is that, yeah, over the years, this company has been quote unquote cheap on a sum of the parts basis. But so what, right? They've never monetized it. It's just been a roller coaster. There've been ups and downs, and over the last 5 years, the stock's down almost 50%. So, it's been cheap a lot during that period of time. So what?
Yep.
So I'm going to close there. Just provide, and we're going to jump into Q&A quickly. I'll provide my contact information. Happy to talk to people about this. I understand it's not like I look for stocks that are battleground stocks, but somehow to be a value investor right now, you have to have a really, I think there's a need to be somewhat of a contrarian and to look at businesses that people are discarding and look deeper and say, well, what are people missing? So I'm always happy to hear comments and feedback. I'm just getting smarter on Lionsgate. We're just getting smarter on Lionsgate. There's a lot of things that we would love to know. Some of which will just play out over time. But I'm always happy to take people's questions. So you can find me on Claremon at covestreetcapital.com. You can also follow me at Twitter. I don't have anywhere near the number of followers that Srivatsan has, but you can follow me at Ben Claremon at Twitter. And then here's my shameless podcast plug. We just started a podcast at Cove Street called Compounders, where we interview public company CEOs about how they build their businesses. So we basically just wrapped up season 1, which will include 12 episodes. We had 2 Fortune 500 CEOs on. We've already booked a Fortune 500 CEO for season 2, which will start in a couple months. But would love for people to give it a try. We think that something's a little bit different, where you have an investor-led interview of public company CEOs, basically allowing people to be a fly on the wall for what Cove Street's diligence process looks like. And with that shameless plug, I will hand it back to you, Srivatsan, and we'll get into some Q&A.
Yep, I think that was a fantastic presentation. So number one, thank you for putting that together, and I think it was really well executed as well. So, but just to keep, I wanted to keep the Q&A short so that people don't end up falling asleep. But so I wanted to start off by talking a little bit about stars and I guess the economics of stars. So people I guess clearly don't have sort of infinite money to go ahead and subscribe to entertainment. So how is stars going to be able to maintain this share of the consumer's wallet when it has to compete with other services like Disney Plus, Prime, HBO Max, Netflix, and a lot of people have criticized Netflix on the same grounds. There's increasing competition. There's also different type of content services as well, and people have criticized Netflix as what used to be a valuation that was very high, especially from say a traditional PE metric standpoint. But then just coming back to stars, how is stars going to cope up with that and maintain consumer wallet share, considering the competition that surrounds it?
I think that's a great question, and it's our largest concern with stars. if you were in our investment meetings, you would hear me being like, who cares about Stars? Like, why is anyone going to subscribe to Stars? Like, if I could have Disney Plus for what, a $4.99, I don't know, maybe they raise the price to $6.99, whatever, or Netflix, like there's a lot more content there. It's really, it's really deep. And so it's a genuine concern. And I'm going to give you management's pitch. And I don't know how much I don't know how much value I will subscribe to this, but to some extent, it's true that Stars is more of a niche product. So they describe Netflix as like a general entertainment subscription service, and that Netflix is trying to be everything to everyone, right? They have documentaries, they have movies, they have TV shows, they have animation, they have kids, right? So Netflix has everything, and Disney Plus in a lot of ways has everything. Stars is more of a niche product, and so particularly focused at Latinx and African American subscribers. This is domestically. The Power Show is kind of like on Stars is kind of like their scripted series that it's their Game of Thrones. Obviously not quite as popular as Game of Thrones, but there's been all these spin-offs and so they have a focused niche that they think is very loyal to the platform and to the content. So that's their approach. And so to some extent, I'm happy to hear that they don't think that they're a competitor to Netflix, because if they did, that would be a little scary. So they are trying to segment the market. And so, it's funny. I was just listening to reviewing one of the episodes that we're going to release on my podcast for next week. And the CEO there told a story about how the founder of this company started a newspaper back in the, late 1800s. Because there was only one newspaper in the city and it only catered to the rich people. And so he's like, there's an entire population of people who could be interested in this in a different kind of newspaper, and there's only one. It's for the rich people. So he created it, and now it's a $2 billion company, right? 140 years later. But my point is that there is value in segmentation, and so that's the pitch. I have my general concerns about just the proliferation of the cost of the unbundling, right? So now you need internet plus, plus Disney, Netflix, HBO, Amazon Prime subscription. How much money do people have to spend on content? And so it is a genuine concern. It is reflected in the valuation that we put on Stars, I think. Given the cash flow profile, given the margin profile of that business are still very attractive, at least on the domestic side. We are concerned, and it's up to management to prove us wrong. And then very quickly on international, it's a good question. Like, you're competing with so many players who are also going internationally, right? Like if Netflix is just penetrating more and more, and Disney Plus is rolling out internationally everywhere, like, how in the world is the international subscriber? What does an international subscriber know about Stars, by the way? Mainly it's the content that you get from Lionsgate that's going to be embedded there. Their point on that is that the company's point on that is that they were an early mover in international. They've been doing this for a few years, and they actually have kind of like a very good base of subscribers to build off of. We will see how sticky those people are when the competition comes. But our genuine point here is that if you look at our valuation from Stars or 4 Stars, it's way less than what they paid in 2016, which is, you would think that if it were becoming more valuable every day, it'd be worth more than 4.
So the other question that I had, which I wanted to ask, and to wrap up the podcast with that, you said that, LGF is sort of a special situation. And, you mentioned that Garry Crawford, the board member at LGF, what he said was that the company was massively undervalued. And I guess management as a whole shares that view. So could you explain, how's the gap between what management thinks the company's worth versus where we're trading at now? How is that gap going to be closed, considering that most acquirers are not going to want Stars? We talked about Stars being the weak point in the company. So how is management going to close the gap between what it's worth versus where it's trading at right now? considering that most people would not want to control stars.
It's a totally fair point. And to Gordy's credit, if you listen to that call, he listed a number of different acquirers, and he said, for every one of these, I could come up with a reason why they wouldn't buy Lionsgate. And I think a lot of those players, the reason is they wouldn't want stars, or that they would value the studio side for the TV production, the movie production really high, but then they wouldn't want stars, and so they value it low, and so then you wouldn't get someone who'd be willing to pay what management thinks its company's worth.
Yep.
So I think it is a very good point. And so the question is, what are they going to do? And so here's the way that we're thinking about this, and to some extent, part of investing is it required pontification and opining on what people are thinking and who, like the people involved, what are their incentives. And so if you look at the strategic committee on the board, this is the group of people who's tasked with considering strategic alternatives and finding ways to create value for shareholders. You have Garry Crawford, who's an investor like us and who was at the Capital Group for a really long time, obviously knows how to make money as for shareholders, right? Because that's kind of like that's what he was. He was a shareholder for all those years.
Right.
Then you have Mike Freese of Liberty, right? You have two guys who and I have no qualms about saying that Mike Freese, given his Liberty ethos and DNA, knows how to create value for shareholders. So you've got two guys who understand how to create value for shareholders and can be creative about it. So here's the options. One, best case scenario probably for these guys is that you don't sell. Is that Stars just does really well, gets 50 to 60 million subs, profitability comes way up, and all of a sudden people have a complete revaluation of A, the whole company, but B, specifically Stars, right? I think these guys would stay in the seat. If you told me the stock was $35 tomorrow, of course they would stay in the seat because they've created a lot of value. They get to, they get their nice salaries and all of that stuff. So I think that's the best case scenario. I'm not saying that the first and only option for this company is a sale. I'm suggesting that when the stock has been down 50% almost 50% over the last 5 years, like things are on the table that may not have been. Yeah. And so what could that look like? Well, could a divestiture of Stars outright maybe be in the cards? Potentially, right? You could sell Stars, de-lever, improve the balance sheet substantially, right? And so if there's a debt overhang at all, or if there's an and there is an interest cost overhang when it comes to free cash flow, that would be ameliorated. And so that might appease people a little bit, and it also might make them even more attractive as like a pure play studio. So that is one thing. I'm not saying that's going to happen. There's a lot of moving pieces here, and tell me who the buyer is. The other thing to think about is maybe the best thing they can do, if they're right that Stars is a legitimate product and has a niche that is durable and people actually actively seek it out as opposed to just being part of a package, then they probably should be spending all the money they can to get to 50 to 60 million subs, because clearly Wall Street likes subscription businesses and really likes kind of D2C streaming businesses. So that is that. I think you have to have confidence that the people are A, focused on closing the gap between intrinsic value and stock price, and B, are not just going to burn money in something that is just a total waste. Relative, when you think about the competitive landscape. So I don't know the answer to that. As I said, I think there are multiple ways to win here. You don't need a sale, and I don't know who the buyer is, and I could throw out some wild speculations out there, and when I talk about one of my other securities that is also a special situation, Lumen, I do speculate wildly. I don't feel comfortable doing that here, but I will say that there's a scarcity value to the studio that we think provides a huge margin of safety relative to the current, the value of that studio provides a huge margin of safety relative to the current stock price. And in the meantime, we should see improving trends that help improve the profitability and the returns of this business. And so you might just get a re-rating based on that. But in the meantime, the downside is relatively low. That's how we've looked at it. But again, it's a special situation. And for me personally, I don't know that I want to wait around and just hope that management does the right thing. We will take information as it comes at us. The company has hired a new IR guy who's great, and he is out there, getting the story out. But also, this Garry Crawford call, like that is something you don't see other companies do, because they want to get this, they want to highlight how undervalued the security is. I think that means people are aligned. Rachesky owns a lot of stock. Burns and Feldheimer own 6 million shares. I mean, this is real money for people, right? So I think we are highly aligned towards a higher stock price. But the path there is uncertain, and we're trying to be in a position where we can win, regardless of whether it's sold or not.
Yep, absolutely. And you made that case towards the end of your presentation as well. You don't have to have one thing happen to win. You could win in many different ways. So, with that, Ben, thank you so much for an incredible presentation and an incredible the sort of description of the long case for Lionsgate. And thank you so much for being on the podcast. I think I had a lot of fun, and I learned a lot. And so I'm probably gonna go look into LGF over the weekend. So so thank you for being on.
Yeah, well, thanks for having me. It's a great discussion. Thanks for giving me the platform to talk about one of our newest holdings. And again, please, I'd love to hear people's feedback on the presentation, because I can only get smarter when I hear from other smart investors.
Yep. Cheers. Thank you.